Frackers, chasing fast oil output, are on a treadmill. Shale companies from Texas to North Dakota have been managing their wells to maximize short-term oil production. That has long-term. By front-loading the wells to boost early oil output, many companies have been able to accelerate growth. But these newer in effect, frackers have jumped on a treadmill and ratcheted up the speed, becoming ever more dependent on new capital to keep oil production humming, even as Wall Street is becoming more skeptical of funding the industry. The emphasis on maximizing early oil output, largely by small and mid-size shale drillers, contrasts sharply with how big oil companies such as Chevron Corp. And ExxonMobil Corp. Are seeking to develop some of the same areas. "You don't try to grow production fast," Chevron chief executive Mike Wirth said in a recent interview. "You really look at Though most shale companies have yet to consistently generate more cash than they spend, their rapid expansion has turned the U.S. into the world's largest oil producer. That growth has begun." Chevron announced plans last month to more than double its production to 900,000 barrels of oil and gas a day in the Permian Basin of West Texas and New Mexico over the next 5 years. Exxon said it. Neil Chapman, who oversees Exxon's exploration and production business, told investors last month that Exxon is trying to be systematic about extracting the most it can from its acreage. "There is a certain amount of energy in this reservoir, and when you drill them up, that energy starts to dissipate," Mr. Chapman said. Another side effect of front-loaded wells: they are unleashing enormous amounts of natural gas. That's because gas production in the two largest U.S. oil fields, in Texas and North Dakota, grew 43% from January 2018 to the same period this year as oil output grew 35%, according to EIA data. There isn't enough pipe. Large quantities are also going up in smoke, as companies burn gas they cannot move or sell, a practice known as flaring. Operators in many wells are producing more oil overall than those of a few years ago, thanks to improved techniques and technology. But in some cases, because oil is more valuable than gas, the shift in the gas-oil ratio means that these wells are less profitable. Higher gas production in the Williston Basin, which extends into North Dakota and Montana, newer wells drilled by EOG Resources Incorporated are producing less oil and more gas than their predecessors, according to data from Shale Profile, an industry analytics platform. The Companas wells in the same area that began producing 4 years later generated an average of roughly 134,000 barrels of oil in their first year, a 41% decline, data show. Meanwhile, the EOG said it wasn't unexpected for well results in an area to vary year to year. These performance in the Permian Basin, Laredo Petroleum Incorporated expects to wring an average of 15% less oil and 13% more gas than previously forecast from its wells over 5 years, the company told investors in February. Laredo is adjusting by increasing the space between its future wells, though doing so means it will have fewer overall locations to drill. The company didn't. While exploration and production companies are modifying their approach, Julie Francis, an analyst at energy consultancy Wood Mackenzie, said they face an uphill climb because of the increasingly rapid decline of their shale wells, likening the situation to trying to refill a leaky cup. "They will have to invest more in order to grow," she said. Write to Rebecca Elliott at rebeccaelliott@wsj.com.
Raindrop, drip, drop top, top smoking, no cooking the hot pot. I get fucking on your bitch, yeah, that.